Welcome to this Skillick Explains video, and welcome to video 2 in my key investing decisions or questions number 2 video. And this one is fund or portfolio. So in video 1 we looked at how much we can potentially afford to commit to equities, and here we're looking at the method, if you like. Do you go for a fund or do you go for a portfolio? And because I've covered this topic before from different angles elsewhere, I'll keep this fairly brief and give you some sources for extra information at the end as usual. So essentially, you've decided you want to commit money to the equity market. There are 3 basic ways to do it: single stocks, funds, and some kind of portfolio. Now, single stock investing is a no-no as far as I'm concerned. It's way too risky, and no firm is too big to fail. Throughout the history of the stock market, if you go back, the biggest firms in the market have had to cancel or cut dividends. I'm thinking of BP here. I'm thinking of Marks and Spencer. I'm thinking of Tesco. These are names where people assume nothing can possibly go wrong. It can do. So single stocks are a no-no, and they're a no-no whether you're buying them directly now as some kind of medium to long-term investment, or whether you're holding them within, say, a pension. You need to be careful if you work for a single employer not to load up on that company's stock and leave yourself under-diversified. So what about funds? All right, that was option number 2. These are collective investment schemes. They're designed to spread risk by taking your money, giving it to a fund manager, or running it through an algorithm in the case of passive funds. And you've essentially got 3 types. You've got the unit trust, covered this in another series called Fund Basics, investment trust companies, which are companies traded on the London Stock Exchange, amongst other places, and you've got exchange-traded funds. Now, basically, these can be useful in the right context, but they don't solve every problem, and they can be a bit limited when it comes to people who have specific requirements or perhaps want to invest larger sums. So that brings me on to portfolios, my third option, if you like. And a portfolio essentially is handing your money over on either a fully discretionary or an advised basis to a portfolio manager. They then pick a variety of securities that go within that portfolio, and those can include equities, bonds, funds, and a mixture of all 3, if you like. And basically what they're then paid to do, if you like, is to either take away the management of those investments completely, or to make recommendations, talk through options on a kind of advised basis. The choice, as they say, is yours. Now, what factors would an investor weigh up in order to determine whether the fund route or the portfolio route is the best one, given that single stock investing is something of a no-no? And here is a reminder about some of the factors that need to be weighed up. There's no right answer. It's a case of sort of ticking them off, if you like, and deciding where the balance lies. And at the end, I'll give you a reference to a source that contains a bit more information on all of them. So first of all, simplicity. If you're not investing a huge amount of money, you're doing it on a regular basis, you might be doing it through an app, then there's a lot to be said for funds, because they are easy to invest in, they don't require much maintenance, they don't require much engagement from you. But what about visibility? Does it matter to you what's under the bonnet? Does it matter to you whether you can influence what's under that bonnet, for example? Do you want to know what's going on under the skin of the investment strategy that you've set up? In which case a portfolio does give you better visibility. A fund manager may declare some of their top holdings, but you won't necessarily know what's going on in the tail of the fund, as it's called. Flexibility. Again, a portfolio will give you a bit more flexibility in terms of how it's structured, how the tax efficiency is worked out, for example, than a fund. But then there's the efficiency and cost argument. You know, it's no point in setting up a portfolio if you're running a relatively small amount of money on a regular basis. You know, a fund will probably achieve everything that you want it to achieve, and there's a lot of choice out there in terms of fund strategies. Access. Some people like the fact with portfolios that they can badger their portfolio manager, they can ask questions, they can have an influence, if you like, they can dictate to a degree how they want to invest sustainably, global growth, with or without specialist services and so on. For others, that's not important. But if the kind of access to the fund manager, if you like, is important, then a portfolio will tend to give you that. Tax planning, well, you can be tax efficient with either strategy. Funds can be tax efficient, so can portfolios, so that's an it depends. From an admin point of view, a fund is probably easier. It's just one investment and you don't get hit with lots of information from different sources as you could be potentially through a diversified portfolio. And that brings me on to diversification, my final point. You need to look at how much diversification is being achieved either by a fund or by a portfolio. With some funds, you're basically overpaying for diversification. I'd argue they're spread almost too thin. In other cases with funds, they claim to be diversified, but actually they sort of passively track some of the biggest companies in the market. So your tech exposure, for example, might be a lot bigger than you actually might assume it is. With portfolios, of course, they can be constructed to give exactly the amounts of diversification, not too much, not too little, that you require. Now, I've just hit you with a lot of things to think about there. So if you'd like to find out a bit more, Killick.com/learn has a funds tab down this side. Then there's a guide, how to invest in equities, that runs through some of those factors I just mentioned. That's editor@killick.com. And finally, there are funds pages written by professionals within Confidence. Sitting next to me, there's a sort of unit trust section, if you like, an investment trust section, exchange traded funds make an appearance from time to time. And again, editor@killick.com for a copy.